assist with reposting if you don't see it. Maybe you left the class or something during the break. Cool. So quick recap before we sort of finalize this session. I'm hoping that will probably be like another hour and a bit, and then we'll be done for the day. So we're not going to run until the 1:30 that I think is in your calendars. But let's see how we go. So quick recap before the break, we spoke about the thought process and the framework. In terms of Asim Mulal was very happy with that. I'm actually, those that know me, I'm banking time for when we run over. So remember this, or in the time where we go until 2 o'clock. No, I'm kidding. New leaf, we're always going to finish at 1:30. That's a promise. Cool. Thought process. We spoke about identifying the issue. We used Lehman Brothers as an example of how we think about issues, how we practically identify issues, right? Just having an inquisitive, questioning mind, and asking questions of each other. So in your groups, I see Mulalo would be saying I thought it left hand. So actually, if the last time I went over was in 2012, that's itself, 2020, sorry, that itself is an achievement. So ask questions of each other in the in your groups, and that's going to facilitate that issue identification. Because the tricky thing about this whole framework is if you get one piece wrong, especially the earlier ones, you're really going to be in a world of pain, right? So we'll be practicing that, identifying the issue, questioning, critical thinking all throughout the program. Then scope. Is the next one. Priska, I see you're unmuted, so I'm going to mute you. But if you want to participate, you're more than welcome to unmute it and jump in. But I suspect it was probably an error. Then account treatment and presentation and disclosure. So now we're going to go a little bit and show this, finish off this framework in action using our Lehman Brothers example. And then we're going to go into more detail on the last three. And then we're going to use another simple example with a lot more issues in there to sort of just unpack a few more accounting standards. And then we're going to look at some accounting developments and then some reflections, and then we'll be done. Cool. So let's use IFRS, Lehman Brothers as an example. So scope, right? The first important thing to understand about a scope, and again, I will share the, we'll have a page where you will see it in writing just now, but I just want to show you practically. It starts with the definition. So a scope will sound like this accounting standards applies to financial instruments. Okay. Then the question is, okay, but hang on. What is a financial instrument, right? Which then brings us into the next very important part of the definition of a section of a standard that deals with definitions. Now, definitions are not just going to define the crux of the standard. It defines a multitude of terms that sit inside your accounting standard. Sometimes they're in italics, and the definitions sit in different places depending on which standard you're dealing with, and we'll deal with that later on. But in those definitions, you will find the definition of the subject matter of the standard. So as an example, in IS 32, that deals with financial instruments, you will find financial instruments as a definition, right here. So if you scroll all the way down, and again, I've obviously zoned into a particular standard in your massive books just to follow on from the Lehman Brothers example. But in the next phase of the session, we're going to zoom out, right? Then we're going to talk about, like, you have so many books. We're going to talk about what each one of those books are, and then we'll go from the top, and then we'll zoom back in. Okay, so this is at the bottom, okay, because of the Lehman Brothers example. After this, we'll go back to the top, and then we'll zoom back down to this level. Okay, just to give you perspective of where we are. Right, so this contents page will become quite important, but I'm not going to cover it now. I'll cover it later. But you see it says definitions. So I'm going to click on that to get to definitions. And in definitions, I'm going to have a definition of a financial instrument, hopefully. So there you go. I'm going to have a definition of a financial instrument, right? So I think somebody. Oh, no. Oh no, Malalo. Okay, hopefully you get sorted there in the chat. Cool. So then and sad to see you go. Anyway, there you go. Have a definition of financial instrument. We're not going to go over the definition of financial instrument because I'm going to tell you a share is a financial instrument, right? So we're almost scoped into this accounting standard. Okay, but IFRS 9 is, or rather, financial instruments is a lot trickier, and we'll circle back to this concept. And the reason why it's a lot trickier is because the different sections of the standard sit in separate standards. Usually you find them all in one standard, but if from financial instruments, they split across at least three standards. So this one, again, you see financial instruments, but you'll find that this standard deals with the accounting for financial instruments, right? And then there'll be a scope again. So you see, like I mentioned, this standard shall be applied to all entities, to apply to all entities, to all types of financial instruments except, right? So we're in the standard because it deals with financial instruments, because we meet the definition of financial instrument. But at the same time, we just need to double check that we don't have these types of financial instruments, because these ones are scoped out of the standard, and we'll need to go to another standard to account for those. So if we have a shares in a subsidiary, associate, or joint venture, or we use other standards to account for those. If we have a lease, we use another standard to apply to those. Except these items regarding leases are part of this standard, right? So it can get quite complex. I'm not going to go through the whole list, but I just want to almost highlight the importance of the scope section of the standard, because then you could either have a transaction that looks like something, so in other words, looks like a financial instrument. However, because in our Lehman Brothers examples, we only had one share in Apple, right? Hence would be in this accounting standard to account for it. But in a scenario where we actually owned all the shares of Apple, so 100% of Apple, Apple would be a subsidiary of Lehman Brothers. Therefore, this standard would not be applicable. It would have to go to another standard to account for that, right? Other standard being IFRS 10. So usually you're given which standard to use for those particular, in those particular cases. Okay. Okay, so that's just the high level on the scope. But what I'm here for is our accounting phenomenon. So the relevant accounting phenomenon we were dealing with relates to the derecognition of financial instruments, right? And again, I'm going to sort of skip a few processes here just to finish off the Lehman Brothers example, but we will come back to contextualize this a little bit better, right? So the derecognition of financial assets is what we're dealing with, right? We'll talk about what that means shortly. And then you'll find that in the section that deal with the derecognition of financial instruments, you've got the principles that are applicable. And of course, financial instruments are extremely complex. So I'm going to skip a lot of the complexities. So the question we were asking ourselves ultimately is whether or not Lehman Brothers should de-recognize those shares. So if you can remember the two accounting alternatives, the cash was coming in irrespective because Lehman Brothers was legally selling the shares. So because they were legally selling the shares, they had to recognize cash. They had to bring cash onto the statement of financial position. However, we were questioning whether or not it was appropriate for Lehman Brothers to de-recognize the shares in a sale. Or does Lehman Brothers still actually, the shares are still actually, they still actually belong to Lehman Brothers, although not legally, but they're still technically theirs. So they should still show them because they're still there. However, this transaction felt like a loan. So we need to bring in some sort of liability here to reflect that loan. Was ultimately where we got to. So in following the principles, right, you see that the question that we're trying to ask is, should Lehman Brothers de-recognize a financial asset, which is the shares? And the IFRS will say, okay, yeah, cool. So this is when you de-recognize financial assets. Okay, so you have your economic view or what you think it should be. However, this is when you should actually de-recognize financial assets. And then let's see whether or not the principles and our expectation of what we think this thing looked like actually align. Okay, so first thing we need to do, so when and only when, so you can see how strict it is. Either the contractual rights to the cash flows from the financial asset expire, right? This hasn't happened because the shares are still the shares. The shares still give right to dividends, and a share buyback, if that ever happens. So the contractual cash flows, the contractual rights to the cash flows from the shares from the financial asset have not expired. So we don't meet this criteria, right? B, it transfers the asset as set out in the paragraphs below, right? Okay, cool. So we can go to the paragraphs below very quickly. Okay. So firstly, we need to transfer the financial asset. Okay. But then you can ask yourself, okay, what does transfer mean? All right. So sometimes, if it's so kind as to give you some guidance, sometimes not. Professional judgment comes in. So you transfer the contractual right to receive the cash flow, right? Which we did. I'm not going to go into the details. We transferred that right by selling the shares legally. So legally, that right to the cash flow has been transferred to the counterparty because legally now they own the share. So now legally the counterparty has the right to the cash flows. Okay, so we meet the first condition. But in the second condition, again, I'm scrolling back quite a few because it's quite a complex standard. The second condition is if we transfer substantially all risks and rewards of ownership. So here is the principle that then here's the key principle that both Lorato and I think it was Mulalo were picking up on without knowing the intricacies of IFRS 9, is that they were like, hang on, we've almost short-circuited the sale. Like the thing that we are selling, it's going to come back in 3 months. And we're going to pay even more to buy this thing back. So we're going to be out of pocket even, right? So to use the principle IFRS 9 uses is Lehman Brothers were still exposed to the risks and rewards of those shares. So whether the price went up, so they made a massive profit, whether the price goes down, so they'll make a massive gain, doesn't matter. Lehman Brothers still had to pay 105. So it means Lehman Brothers is still essentially exposed to the risks and rewards of those underlying shares. So me, as a user of the financial statements, I need to see that on the financial statements. How do I see that? I will see that by seeing the shares recognized on the financial statements at fair value. So when the price goes up, I'll see that gain. When the price goes down, I'll see that loss, irrespective of the fact that those shares have been legally sold. Right? But the economic reality was that Lehman Brothers was still exposed to the risk and rewards of those shares. And the economic reality was that Lehman Brothers actually obtained a loan. So if the entity retains substantially all risk and rewards of ownership of the asset, the entity shall continue to recognize the asset. So Lehman Brothers needed to continue to recognize those shares. However, what do they recognize in its place? If a transfer does not result in derecognition because the entity has retained substantially all risk and rewards of the financial asset, it shall recognize it shall continue to recognize the transferred asset as Lehman Brothers was supposed to do, and shall recognize a financial liability for the consideration received. So to Lorato's point, which this is just us, this is just Lehman Brothers obtaining a loan. Secured by the shares. Therefore, what they should be accounted for is actually a loan, a financial liability for the consideration that they receive. So they recognize 100 being the cash, but on the other side, they also need to recognize a loan of 100. And that 5 is effectively just interest, which I think somebody said in the chat, which they need to recognize using the rules in IFRS 9 as well. So this is now how then we almost like marrying the two and saying, okay, what we thought from an economic reality perspective is actually also coming through from the rules in accounting when we apply the principles. And notice here how there isn't anything that said repurchase agreement here. There isn't anything that said repo 105 here. Um, uh, and that's the nature of principles. So we've got principles that are equally applicable to all financial assets. And what we did was we just used our judgment to apply these principles to a sale of a financial asset, and at the same time, a sale and repurchase rather of a financial asset. And using the principles, we're able to come to the correct answer. But just like with IS 36, to assist with applying principles, the standard gives examples typically. And again, we will zoom out and we'll talk about this again. Let me try to find it here. I hope I find it. Yeah. So here is to help you sort of apply the principle. So examples. So because IFRS is very principles based, it's very good at giving examples of how the principles work. But you must never read the examples as a rule, right? It's just, I mean, and I say this, but in practice, there are some might treat it as the closest to a rule that you can get, therefore it's closest to the consistency that you can get. But at the same time, it's very hard to challenge when an example when the IFRS says this specific example meets this principle and your economic phenomenon is exactly the example, right? Then I mean it's really hard to challenge. But you must never forget that it's not because you're applying a rule, which is the example, but no, it's because you're still applying the principle. It's just the example helps you to apply the principle. Okay. There we go. So we've got an example of when an entity has retained all risks and rewards of ownership are, where you have a sale and repurchase transaction where the repurchase price is fixed, is a fixed price. There we go. So that's literally our fact pattern. So it is an example of a scenario where substantially all risks and rewards are retained. And then the impact of that is that we are prohibited from de-recognizing that financial asset, but instead we de-recognize a financial liability for the consideration received, which is what Enron should have done. Then after we've dealt with the accounting treatment, we're not done yet because yeah, we've done our debits and our credits, we've recognized, de-recognized, but then how do we then go and present and disclose this information to the users so they can make decisions, so they can understand, excuse me, so that they can understand what's been happening, right? So then you've got the disclosure, and again, for financial instruments, it's complex because it's a separate standard, but usually all of this is in one standard. And then you've got a section that deals with transfer financial assets that are not de-recognized in their entirety. And then what then the standard does is, okay, says, okay, these are very complex transactions. And of course, in the wake of what happened with big corporate failures like Lehman Brothers, in response to that, always to ensure that information users are receiving is relevant for their decisions. Disclosure. So when you have these transactions, IFRS then requires you in the notes to then disclose a few pieces of information that would be useful for a user to understand the impact of those particular transactions. And in particular, you see it's a laundry list of what needs to be disclosed. So for example, you need to disclose the nature of the transferred assets. So for Lehman Brothers case, in our example, they need to disclose the nature of that Apple share that it sold, right? It's a share in Apple. And they need to describe the nature of the risk and reward that they're still exposed to, right? They can say we're exposed to the full price risk of this share, right? a description of the relationship between the asset sold and the associated liability, including any restrictions in terms of the use. And all these recourse requirements that I'm not going to go into a lot more detail on. But the point I'm trying to make is that's the role disclosure plays. So we've done our debits and credits. We've accounted for this thing at this way. We've presented this thing as a loan, but then that's not enough, right? Because now when a user looks at the face of the statement of financial position, they think Lehman Brothers just has normal loans on its balance sheet or the statement of financial position. But that's not the case. It's actually far more complex than that. Lehman Brothers is entering into complex transactions here, to which it is important that the users of financial statements understand what is the impact of these particular transactions. And that's the role that disclosure plays. So I'm going to pause here because I've been doing a lot of talking. And I want to check if there are any questions before we zoom out and then come back right in. Any questions? And just in general, you're more than welcome to pop a question in the chat. You're more than welcome to just unmute and just talk. I'll stop at any moment to give you a chance. You're more than welcome to put your hand up, whatever method sort of you prefer. I don't mind. I actually want the engagement. I want the questions. So whatever I can do to make it much easier for you all to ask those questions, I'm more than happy to accommodate. Please don't feel that you're being rude or anything. Okay. Zoom out. I'm just trying to think. I think I prefer this one. Is it? Yeah, I prefer this one. All right. So let's zoom out. So I think it's 5 books now, if I'm not mistaken. I hope I'm not mistaken. But yeah, someone can correct me if I'm wrong. I've been using the electronic version of these standards for so long that I actually have no idea how many books it is these days, but I think it's still 5. So you've got a massive tower of books that Tom mentioned. That's hopefully somewhere nearby. And that massive tower of books is split into 3 parts. So thank you, Nomfundo. You've got part A, which will comprise of your main standards, and part A I see is still split between A1 and A2. That split, if I remember correctly, is still, or at least it was in my time, and hopefully still the case. A1, I think if I remember correctly, was all the IFRSs, and A2 was all the IASs. What's the difference between an IFRS and an IAS? They're all accounting standards. Sorry, I'm not answering. I mean, you can answer if you want to answer, but I wasn't actually asking. But if anyone wants to answer, you're more than welcome to jump in. Okay, what's the difference between an IAS, so International Accounting Standard, versus an IFRS, International Financial Reporting Standard? It's really just a timing thing, to be honest. So an IAS are the older standards, typically, and the IFRSs are the newer standards, typically. Thank you, Amos. And because of that, they have slight differences in their design. And because of that as well, you'll find that the IFRSs, so the new standards, are much more rich in guidance and principles and examples and basis of conclusions, whereas the IASs are much thinner in all those things. Therefore, the room for the need to apply judgment in the IASs is far bigger than that in the IFRSs. But at the same time, the IASs generally deal with what have remained non-complex accounting phenomenon until recent times, and we'll talk about the future direction of accounting shortly. Therefore, there's generally not like an extreme need for sort of complex guidance, whereas the newer standards, if you think leases, if you think revenue, if you think insurance contracts, deal with much more complex accounting phenomena or economic phenomena. Therefore, much more guidance was necessary and is necessary to deal with those accounting issues, like revenue as well. But of course, like I said, that's ever evolving. For example, leases and revenue very recently got a massive uplift because the old standards were not fit for purpose anymore. Okay, so part A, you have A1, which will be your IFRS, A2, which will be your IASs, all accounting standards, differences just in design and level of content because IASs are old, IFRSs are new. Okay. Part B are your illustrative examples. Again, you'll find the exact same thing like with IFRS and IASs. So you'll find, so I'll say for roughly each accounting standard, it is accompanied by an illustrative example, right? So this part B is a bunch of sections as well. And I say roughly because it's not a one-for-one. So you find that a lot of the IASs don't have illustrative examples. And some that do, you'll find that they are quite thin. You'll find like 1 or 2 examples, maybe 3, and not a lot. But if you go to like the latter step, the IFRSs, it's actually quite substantial, sizable sort of I'll call them standards that provide illustration. So what is the objective of illustrative examples? It illustrates how the principles work. So it is an important and a useful resource for you when you're also thinking about these principles or trying to upskill yourself in the 5 days research period. But it's an often forgotten resource, right? But the people that are setting your exams, don't forget these resources. So just remember that. Don't forget the illustrative examples. Now, the latter standards are quite good at referencing when there is an example. So I'm hoping I don't get embarrassed, but let's have a look here. Like if you go to, let's do 16 as an example, because that's one standard we're going to be working with a little bit. There we go. So in the newer standards, they are much better at referencing. So when they identify a concept, i.e. identifying a lease, and then they introduce how the concept works, how the principle works, they're quite good at also referencing some illustrative examples that you can go and refer to help understand or think through the principles that you're going to be reading about. And there's a lot of examples. You see, like how many examples there are in the newer standards. So the newer standards are also quite good at cross-referencing. So don't ignore these cross-references when they're examples. And again, the requirement is not for you to read all of them, right? It's just to say each example illustrates a principle. So 1A will illustrate a consideration as an example. 3A will illustrate how the concept of right to control works. 4 will illustrate the principle of how substantive substitution rights work. 5 will illustrate another principle. So each example is geared at illustrating a specific principle. So it's not that you need to work through all the examples, but they could just potentially be an example that helps you think about a principle that you're trying to think about. At the same time, there could be an example that inspired the question that an examiner is asking. You never know. So that's part B, illustrative examples. I think there's only one book for that because, again, sort of one-for-one relationship. Then you've got the basis of conclusions. Now, the basis of conclusions is just a record book of how the IASB drafted or developed the accounting standards. Now, you don't need to know that. And if you find yourself needing to go to the basic of conclusions, then you can just read the part that's relevant to what you're trying to find out in terms of if you're just trying to understand why the ISB used a particular word, or if you're debating what a particular word means. There could be something in the basis of conclusions to help you figure that out, but it shouldn't be something that you should stress about. It shouldn't be something that you should think you need to study and also know when you're learning a new standard. Really, you really need to only go in there when you really, really, really want to dive into the genesis of a particular paragraph. If there's even anything in there that describes it, right? Again, sort of one for one. It's almost like it's just a summary of everything they deliberated. Including there's also like different views, right? So they'll also talk about like the other views other people had and why they did the ISB didn't go that way, etc., etc. So it's a lot of information that you don't really need. So what is your key takeaway? You don't need to worry about part three. Okay. Really. It's really just part A, part B. So at least you can whittle down your, but don't throw it away, please. You can use it as like a door stopper or something maybe. Or you can use it to prop up your laptop. I'm sure you can find a use for it. But don't throw it away. But yeah, part A, part B is where it's at. C, if you really need to go there, you can go there. Or if you really need something to help you sleep at night. No, in fact, don't even do that. Rather read your tax legislation. Cool. So that's birds. I don't even know what color the books are these days, but that's almost the top to give you that sense. Okay, so let's go one level lower. So one level lower is into the main standards. So let's go into, right, sorry. So as part of the standards as well, and I don't know which part this now sits in, you also have IFRS. So IFRS is the International Financial Reporting Interpretations Committee. They now changed their name to the IFRS, so International Financial Reporting Standards Interpretation Committee. So IFRS IC. And what they do is their role is just to interpret existing standards. So they don't set accounting standards like the IASB does. The IASB is responsible for like drafting standards. The IFRIC are responsible for interpreting existing standards. And where they can't interpret existing standards, then they refer the matter upwards to the board if the matter is pervasive and important enough. So ultimately, how the IFRS Interpretations Committee works is people submit fact patterns, and then they just ask people from all over the world. It can be regulators, it can be preparers, and they just ask, listen, we have this transaction. We've been trying to figure out how it works from an accounting perspective. Well, there's two alternative ways you could do this. Which way is the right way? And then the IFRIC then says, okay, cool. Is this issue pervasive and important enough? Okay, it is. Okay, we'll take it on our agenda, and let's see if we can answer the question using existing accounting standards. If they can, then they publish what is called an agenda decision. Now, some agenda decisions have resulted and have been published into accounting standards that I've highlighted here. I do not know the names of these agenda decisions off by heart. I know what's in here, but I don't know which one is which. I always forget. My point is, these agenda decisions are essentially published standards as well, right? So they're also important when it comes to dealing with accounting issues, right? And when you're doing your research, one might pop up, right? So something might be triggered regarding a non-cash distribution to the owner. When you're doing your research, you'll be like, oh, okay, this is done in this particular effort. And then you can almost like, we'll talk about a little bit about sort of how these efforts work. Okay, so let's go to NIFRS. All right, let's go back to my slide. So what is the general structure of of an accounting standard. I say general because all accounting standards are very different, and they don't have to all have all these sections, but generally you will see the structure in most standards. So accounting standards have the following. So the first thing that they deal with is an objective. And we work through the objective of IS 36. Important for you to understand the objective of the standard because that helps you apply judgment. If you know why the standard exists, then when you're almost in a little bit of a toss-up between two outcomes or you're wondering which direction to go, you can always refer back to, okay, but hang on. What is the standard trying to achieve? It wants to achieve X, Y, Z. Okay, cool. Which option that I'm thinking about better achieves that objective? Scope, we spoke about, right? How do I know I'm in the standard, which is linked intricately with definitions when scoping. But at the same time, there could be many other terms in the accounting standard that are also defined, right? We refer to those as defined terms. Okay. Then we've got sections of the standard that deal with the initial treatment of of a transaction or an accounting phenomenon. And then we've got two very important words: recognition and measurement. Okay, and I want to pause here and because I've been speaking for so long, and ask what do you understand the word recognition to mean? And what do you understand the word measurement to mean? Any thoughts? What does recognition mean? What does measurement mean? Anyone? Yeah, go for it, Lawata. No need to raise your hand. You can just jump in.
So with recognition is more to say, when do you recognize something as a particular, if it's a lease, when you start, at what point do you start recognizing it as a lease for you to account for it? And that then will determine how you initially measure that particular item, asset, or be it a liability in your books, at what value and how you would bring it in and what would you take into account, whether it will be cost or market value or whatever, fair value, whatever it is.
Absolutely, absolutely. So going back to recognition, and I think you eventually mentioned that is essentially when do we bring it onto our financial statements? And I see there in the chat, Amos and Ledima mentioned that how the item will be classified and recognition is identified. That's almost a step earlier, right? So what is this phenomenon? Okay, that's a very important question, which is what Amos and Ledima you're alluding to. What is this? Identify it. Yeah, exactly. What is this? What is an asset? Is it a liability? Is it an expense? Is it an income? To do that, we rely on definitions. Okay. What is this thing? Is it an asset? Is it a liability? Is it an expense? Or is it an income? Okay. Once we have identified this thing as one of these items, right? Then the next question is, okay, fine. Which accounting standard, and all of this sits in the conceptual framework. Then we say, okay, fine, which accounting standard do we use to account for this thing? And that is sometimes referred to as classification, but more technically correct way to say it would be scoping. And then you say, okay, fine, I've got an asset, which is PPE, property, plant, and equipment. Therefore, I am in IAS 16. Cool. Now the next question is, okay, when do I bring this PPE on my financial statements for the first time? When do I uplift this phenomenon into my financial statements? Okay, because before the phenomenon is just like someone. The phenomenon is I bought a fridge. That's the phenomenon. You've said, okay, fine. A fridge is an asset. Cool. A fridge is what type of asset? A fridge is a part of property, plant, and equipment. All right, so that means my fridge would be within the scope of IAS 16. Cool. Now, at what point do I take this fridge and uplift it into my financial statement? So at what point do I reflect this fridge in my financial statement for the first time? Initial recognition. Okay? I'm recognizing this thing, right? It's a phenomenon, but now I'm recognizing it in my financial statements as a phenomenon to report to my stakeholders. That's what initial recognition is. So there's a lot of different rules on initial recognition depending on which standard you're in. If you ask IFRS 9 financial instruments, it will say recognize this financial instrument for the first time when you become a party to the contract. If you ask IAS 16 PPE, it will say recognize the item of PPE when you can reliably measure the amount and it's probable that it's going to be future economic benefits in the future. You ask IFRS 15 revenue, it'll say recognize your revenue as you transfer a goods and service, as you transfer control, as or when you transfer control of a goods service to a customer. So each accounting standard has its own different rules of when you bring phenomenon from being just a phenomenon somewhere in the air to the financial statements. Initial recognition. Then the next key question, which all three of you have correctly outlined, Lorato, Amos, and Ledima, is, but hang on, how much? Yes, I'm now bringing this thing onto my financial statements, but at how much do I bring it into my financial statements for the first time? So with this PPE, with this fridge, with this what other examples I have? With this revenue or this financial instrument, there's the shares that I bought in Apple. How much? What's the number I'm going to put it? What's the dollar value as Amos has put it? That is initial measurement. If it follows subsequent measurement, is then okay, now going forward, how am I going to measure this thing into the future? So at each reporting period, whether it's interim or year end. And then that's where the concept of classification rears its head again. Because in subsequent measurement, some standards require you to classify economic phenomena that you've recognized based on various rules, and that classification will drive how you measure it subsequently. So you could have a financial asset that's classified at amortized cost or classified at fair value, depending on various rules, and that will dictate whether or not you subsequently measure that financial asset at fair value through profit and loss, or at the constant yield methodology called amortized cost. PPE, you've got the revaluation model classification or the cost model classification. Do I depreciate this thing over its useful life, or do I depreciate and revalue this thing through other comprehensive income periodically throughout its life? Sometimes you have accounting policy choices. For example, PPE is an accounting policy choice. You can decide whether or not you want to do cost or revaluation model. Whereas for financial instruments, it's less of a choice, and you need to meet certain criteria before you can make a choice. Or if you don't meet the criteria, you have to account for it in certain ways, depending on the facts and circumstances. And then ultimately, it ends then with getting rid of this accounting phenomenon. So back to the Lehman Brothers example. We went through this whole exercise. We identified that we had an asset, or rather Lehman Brothers identified that they had an asset, excuse me. And then they identified the asset that they had was a financial instrument. So they scoped it into the financial instruments accounting standard, right? It wasn't scoped out. To do that, they use a definition of a financial instrument and the scoping requirements of financial instruments. Once they were comfortable that they were in the financial instrument standard, IFRS 9, they initially brought the shares onto the financial statements at the date they became a contractual party to the arrangement to buy the shares. They measured it initially at fair value, which is what's required by the standard, which is usually what they paid for the shares. Subsequent to that, the rules in IFRS 9 would require Lehman Brothers to measure those shares at fair value at each reporting period. And then another phenomenon happened, which was the sale and repurchase that we spoke about, which then raised the question as to whether or not Lehman Brothers should be de-recognizing those shares. We ran through the requirements earlier and we noted that, the requirements say do not de-recognize the shares. Therefore, because Lehman Brothers did not meet the requirement to de-recognize the shares, they had to continue recognizing the shares at fair value. Okay, but then account for the other economic phenomenon, which is the loan, separately as a financial liability. Okay, so that's and again, all derecognition rules are different. And you just have to sort of read what the principle is, learn it, and then apply it to your scenario. And again, the financial instruments derecognition principles are complex. So don't be sort of put off by what I just showed you earlier on. Usually it's far simpler to apply that criteria. Okay, then the standards then sometimes deal with presentation. Presentation deals with what you show on the face of your financial statements. So the statements that comprise of the face of the financial statements are being listed there. So what you put in the statement of profit and loss, other comprehensive income, statement of financial position, statement of cash flows, and statement of changes in equity, anything you put on there, that refers to presentation. So current versus non-current split on the statement of financial position, that is a presentation concept. Disclosure is what sits in the notes. So disclosures can be narrative, they can be qualitative, they can be quantitative. You can have tables, you can have numbers that need to be disclosed, discount rates. Really, disclosure is quite a vast type of concept. There's no sort of rigid rules. Um, and it's just information that the IASB, when they developed the standards, believed would be useful for users when making decisions. And of course, all of this is on the backdrop of relevance and faithful presentation, i.e., if not material, then none of this matters, right? Cool. So back to a practical view of what this all looks like very quickly. If you look at the LISA standard, if I zoom out, you will see all of those, or most of those sections, not all of them, right? With a few caveats, right? Because like I said, not all of them will perfectly look like what I just showed you, but they all cover the same thing, right? Because every standard is unique. So we've got the objective, we've got the scope, then we've got recognition exemptions. So what that deals with is I've got recognition rules in the standard, but here are a few exemptions where you don't need to worry about those recognition rules. Okay. Then, because the concept of identifying a lease is quite complex, right? There's a dedicated section to this. So usually you will find the definition. So if you read the scope will say this standard applies to all leases, right? Usually you'll find a definition of a lease here in Appendix A. So with the newer standard, with the IFRSs, right, they have appendices which comprise of defined terms and application guidance. You can ignore these two sections. Okay, these two important, A and B, C and D, ignore, not important. Usually you'll find the term, you'll find the definition of a lease in Appendix A. However, because the concept is so complex, the standard has a dedicated section for that. So you'll find these nuances. So like I mentioned earlier on, it's not to say that all standards will look exactly like what I showed you here, but they'll have all the components that are relevant, and they might emphasize or de-emphasize certain principles depending on what's important to the standard. Separating these components, so unit of account, is another specifically important concept. Why this is in caps and this is in small letters, no idea. Lease term is also another specifically dealt with concept in the standard. Okay. Then you can see a little bit of the structure that we spoke about. So the standard then splits between lessee and lessor accounting, and then talks about the recognition rule, right? To which you need to read with the recognition exemptions up here, right? Because you could meet the requirements down here, but apply an exemption up here. Therefore, ignore this rule. Ultimately, that was what that means. And apply a different rule that sits up here. Then measurement, like we spoke about. So now in recognition, it's not shown here, but if I click on there, it will have, okay, recognition is recognition, but in measurement, it will have initial measurement. And then a bit lower, it will have subsequent measurement, right? So again, the type of structure that we spoke about, repeating, then presentation, then disclosure. Then the lessor repeats the same thing, but in lessors, there's an extra step regarding classifying leases, because for lessor accounting, for subsequent measurement, it's important how you classify a lease. So it has a section for that. The presentation disclosure, so leaseback has its own section. Then appendix, very important, like I mentioned. Appendix A has all the definitions. So to have sort of all the definitions you're looking for, which all the defined terms, sorry, rather. Appendix B. Application guidance is extremely important. It is long, fair enough, but that's where IFRSs really shine. And this is where your examiners will live. Because the main standard gives you the main principles, right, that you need to be thinking about. But the application guidance now takes it to a practical level. It says, okay, now as you're busy trying to apply these principles, we know you're going to encounter these types of problems when trying to interpret the principles. So here's some guidance to help you apply those principles. And it literally says this appendix is an integral part of the standard. Okay, it's not a nice to have. If you read the illustrative examples, it's the language is like, oh, this is a nice to have, right? It doesn't really say this is an intricate part of the standard. It's like, oh yeah, this is nice. This is just to help you find your way. Let's find it for 16 here. I think it was that statement that I just skipped, but I just want to see here. So here we go. Does these examples accompany but are not part of IFRS 16, right? They illustrate the standard, right? And it's very useful still to get that illustration of certain principles. However, it's not a core part of IFRS, even though in practice we treat it as if it's a core part of IFRS, because it's very useful, those examples. Appendix B is a different statement. This is an integral part of the standard. So ignore it at your peril, right? Of course, you don't have to read the whole thing. You just need to come to the application guidance where you want more, where you need, or no, not even want. You should always want more detail, right? And again, with the newer standards, the referencing is amazing. So you can read a core principle in the main text, right, of the definition of a lease, and then you can sort of very quickly refer to the specific. Look at how awesome this referral is, right? It literally is down to the sentence. So if you want to know about right to control the use, refer to that part of the B paragraph. If you want to know more about identified asset, refer to this part of the B paragraphs. That's how like granular the referencing is. Okay, so use that to your advantage. Cool. But then if you have a look at this, I'm going to go back here to the contents page of IFRS 16, one of the newer standards. But then if you have a look at one of the older standards, I think I had 36 up. And 36 is even a worse example, actually. But it's fine. It'll do. You will see that you have, again, the main sections of the standard, the typical ones. You'll note that definitions are not in an appendix. So the definitions are like a paragraph in the standard. So that's one main key difference. But you see the split of the standard will be generally the same. But because of what IS 36 is as an accounting standard, you'll note there's no recognition principles. All right, here it is, sorry, for P&L. So there's no like, when do you initially recognize an asset? Because that's not what the standard is for. This standard is for impairing assets. Therefore, it still has measurement principles, but in certain circumstances, you may need to recognize a loss or profit if you're reversing impairment, and then it has sort of those recognition principles to help you out with that. Okay. Let's have a look here. Cool. Any questions before I deal with one of the last few items of our sessions, and then we'll go to chat about developments. Any questions? Okay, I see I've got one in the chat. Where possible, please share a link where we can download IFRS standard soft copies. Yeah, Tom, I think I also need to refresh mine because my standards are like old. They're quite old. So what I'm going to do is, and I'll collaborate with the team in the background, is I will download updated versions of the standard, and then we'll see if we can put them onto SharePoint if we're allowed to do that. If not, then we'll just share instructions on where you can go downloading them. But as a short-term fix, and you should have this regardless, I've shared the link to the IFRS organization website. Go there, register for an account if you don't have one already. And there you will be able to find online versions and download copies of the standard. However, you'll only be able to download part A. You won't have access to part B or part C. So what I'm going to try to do is I'm going to refresh all of mine, part A, part B, part C, because mine are quite old now. And then I will see if we can share those on SharePoint, if we're allowed to. Cool. Right. Now, then you're going to ask me, hang on, but Austin, like, there's so many accounting standards. We dealt with Lehman Brothers, and okay, no, sorry. Before we actually talk about this, just one more exercise, and then we'll talk about what I want to talk about, and then we will do developments, and then we will be done. So, hang on, has it been an hour since we came back from a break? What's the recording saying? It doesn't actually say. Okay. So I wanted to just have a quick read of this particular paragraph. And for me to sort of talk to that slide that I was about to talk to, I need help with identifying phenomena that are happening in this in this paragraph, that you think we need to be thinking about whether or not we should be accounting for something or disclosing something or doing something. So I want to do a little bit of issue identification with you all. So I'll read it out once, and then I'll give you like 2 minutes. Okay, thanks. Thanks for that, Tom. I'll read it out once, and I'll give you a couple of minutes to just think through it. Then we can just identify some. We can just all verbally share some issues. So we're having a debater here at work. So this is from a former CTA candidate, and for the life of me, I've been around for a very long time. I can't remember, like this fact pattern just seems familiar to me, but at the same time not. But anyway, So I wonder whether or not this CTA candidate asked me or asked Renani, and then he just shared it with me. But this, when I was reading this, it gave me a lot of deja vu. So we're having a debate here at work. The company recently, and I hope you have a lot of debates with your team. Our company recently entered into a licensing agreement for a right to use another company's trademark in its manufacturing process. Using that trademark, we produced some items that are generally sold to the public, of which some were actually sold during the year and others are still on hand. The issue we now have is around the accounting for the payments we made to the owner of the trademark. I am of the view that this is essentially a lease agreement, and therefore these payments should be treated as a lease payments. However, one of my colleagues is suggesting that since the trademark is used to produce inventory, then the payment should be treated as part of the cost of inventory. Who is right? LOL. Now, of course, one issue is very clear from the debate the candidates having with their colleague. But I was just curious to also, I guess, get from you what issues are coming up, whether it's the one that's super clear from the CTA candidates and the debate, or whether there are extra issues in here that you also think deserve some consideration as to whether or not we should be accounting for these phenomena. Can I get some thoughts? What are the accounting phenomenon that are jumping out at you, even if it's the one that the candidate pointed out? Can I hear some voices, please? Anyone? We're almost there, promise. I'm not going to do another break because I think we just have another 15 minutes, so 15 to 20 minutes. So I don't think it's worth having a break. Let's just push through. Can I hear some voices, please?
Okay, I'm gonna attempt.
Hi, Lorato, thank you.
Yeah, so it will be important to understand what the terms and condition of this trademark use is, and whether there's any underlying conditions that might, raise another form of asset or liability. But essentially, if you're making inventory, which is somehow you'll have to account for that cost, because the value of what you pay for the trademark is used in producing a product that you're selling, which will be your inventory. So yeah, both of them, but then somehow you would need to account, and then backing. It's not called capitalize. I don't remember what it is now. Where you are for accounting for inventory, where you include cost of material, cost of equipment that you use to produce that product.
Absolutely. So if I'm hearing you correctly, so I'm just staying at the issue stage. You have identified two issues. Issue one, we need to figure out the T's and C's of this trademark because there's a trademark we need to account for. That's right. And issue number two, we're obviously producing all the stock inventory to which we're using the trademark and potentially incurring other costs. Therefore, we need to figure out how to account for that too. Absolutely. Completely agree. So you've got the trademark when we've got the inventory that we are producing. Anything else that's coming out at this that needs to be potentially shown in our accounts? So Harry says, I feel there's a lease implication for the right of use asset. Subsequent interest. Additionally, I think the phenomenon is just normal accounting for inventory and revenue. Okay, so Harry picks up revenue as an add-on. So can I hear about the revenue? Why are we thinking that there should be revenue we should be accounting for? And anyone can answer that?
The items that have already been sold.
100%. So now we've got activity happening, which are these sales. And thanks, Harry, for putting in the chat as well. Similar to Lehman Brothers, okay? We've got the sale that's happening. And then now the question is, okay, how should we, and if so, how should we be accounting for the sale? Like, do we have the same problem with Lehman Brothers where, yeah, there were sales happening, but there was also an agreement to repurchase? Are the facts and circumstances different here? And if they are different, then how does the accounting then result, right? So you also have these sales that are going on. Anything else? An element of royalty accounting for the trademark.
Yeah.
Okay, cool. I think that's part and parcel of the trademark accounting. Yeah. So how are we going to figure out that royalty element? And is that a phenomenon that we need to be accounting for? Amos?
No, I wanted to mention there's the issue of selling to the public, obviously, versus not selling to the public, which might have
Yeah.
been for development purposes. So that makes a difference. And then there's the issue of the lease agreement. Is there even a lease agreement?
Mm.
Yeah.
Absolutely. That's a fantastic question, Amos, and it links into Ladima's comment in the chat there. Because Ladima is saying no, a trademark is an intangible asset, and we need to expense the payments as we make them. So now it's like, okay, fine. Do we have a right to use the trademark, or do we control the trademark? So are we in lease world, right of use asset, and the asset that we have the right to use is an intangible asset, just so happens to be an intangible asset, or are we actually have an intangible asset by virtue of the fact that we're paying these royalties or these payments, right? And that is a fantastic question, and even a question that in practice we grapple with, because the way sort of IFRS 16 is written as a newer standard, and because IS 38 is so old, the interplay of the two standards isn't as seamless as we would like. So there's a lot of questions and diversity in practice regarding this specific question, which we'll touch on shortly as we close the session. So ultimately, um, 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 and another key question that's just been reminded here by the first bullet is the timing, right? So obviously now we pay these payments over time, right? But does it change if we made the payment upfront for the license for a period versus annual payments? Um, does it make a difference? Or do we need to account for something when we sign the licensing agreement, even though we haven't made a payment yet, but just signed the agreement? Is it something we need to account for there? So these are all like very, very, very important and pertinent questions that the only way to deal with accounting for these, and we're not going to go into details now because we just don't have time to. Or rather, because we couldn't be able to go into detail with all of these. But the skill that ultimately will become extremely important sort of going forward is then how do you go through this process? Or is it this process of identifying an economic phenomenon, scoping it into an accounting standard, and then going through the initial recognition principles, initial measurement principles, subsequent, etc., 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 and going forward. And that is that essentially what we've already spoken about regarding the scope. Now, the tricky part is, where do you start, right? Because as I'm sure many people will very quickly say to me is, but then hang on, there are like so many accounting standards. How do I even know where to even start? And really, that's potentially the only thing that I would say, if you're not comfortable with every single standard that you have. Because remember, if you're coming from ITC or even ACA, your universe is very small, right? Because you've got the scope of your syllabus. When you come to APC, now everything is, I mean, granted, they may not give you the super complex standards, because it's very specialized. So they might not give you insurance as an example. But the point is, the universe of accounting standards that now become relevant become extremely vast. So and you're not going to be able to learn them all. But what you need to know is what you have, right? That should be your starting point. Like, what are the main standards that exist, or all of the standards that exist? And at a high level, what do they deal with? So what I would like, the only thing that I would ask you to do, which involves canvassing all of the standards, is almost like having a cheat sheet for yourself. And if you once you get the electronic versions of the standard, or in fact, you can even ask AI to do it. I think ChatGPT or something, I'm sure could do it. Where you just literally just ask it to just list all the accounting standards in one column of a table, and in another column, just extract the objectives of the standard as is written in the standard. And then maybe on a third column, ask it to give you 2 or 3 sentences of what the accounting standard deals with, right? Then you're going to have this wonderful table. I'm sure it will be able to do this. That then at least gives you a bird's eye view of all the standards that you have, right? And then when we conclude the session, I will just share with you a few core standards that if you have some time, you can go ahead and take the time to like learn and read through. But if not, that's also not a deal breaker, because ultimately the way APC is designed is because you are given a trigger. So you are given an issue. You have time to prepare for that issue. So uplift your knowledge of an accounting standard during those 5 days to prepare yourself to deal with any accounting issues. So you don't need, unlike ACA or IAC or ITC, if you wrote that exam, you don't need to know the stuff off by heart. I mean, you have the books, but because you don't know what's coming, this time you can focus your attention on a specific area because that area is triggered. So what becomes more important, like we discussed before we started, was knowing how to navigate your way through these accounting standards, which is what we spent the whole of today trying to do. So once you have a little table from ChatGPT, or you can do it yourself if you want, what you will find is typically the standards are broadly can be categorized into these sections. Right, so you've got the conceptual framework. So the conceptual framework is ultimately the technical principles or framework or foundation for the rest of the accounting standards. So the technical framework provides the framework that underpins the accounting concepts in IFRS. So it's relevant for 2 reasons. One, it's used by the IASB to develop new accounting standards, right? So it's almost like their foundational principles that they use. So they use that to develop specific standards. And the framework can be used by us where there isn't an accounting standard that deals with a specific concept. So typically your first prize is to find the standard that deals with something and then go there. If there isn't such a standard, then you can fall back either to a similar standard, so using IAS 8 accounting policy choice, or you can use the framework to develop an accounting standard or a framework to account for something. Of course, that comes with massive disclosures, but that's an approach that you can take. So that's the rule of the framework. Then you've got presentation, like we spoke about, those statements, ultimately what you present in the face. Then you've got dedicated disclosure standards. So these standards have nothing but disclosure stuff in them. So there's no accounting treatment stuff, there's no recognition, there's no measurement, nothing, just disclosure. Okay, there's 4 of them. So you've got IFRS 7, which we looked at very briefly for financial instruments. You've got IFRS 12, an often forgotten standard for subsidiaries, associates, joint ventures, and structured entities. IAS 10, events after the reporting period. IAS 24, related party transactions. Okay, this one's obviously very topical as well because of all those off-balance sheet subsidiaries that everyone keeps hiding stuff in, right? So related party transactions is quite a crucial area in accounting, but these are pure disclosure standards. Then you've got the asset type standards. So if you have a phenomenon and you say, oh, I've got an asset, like I've got inventory, I've got a trademark or the right to a trademark. Then you can think about all of these accounting-based standards to potentially deal with that accounting phenomenon. Right, sitting here is IS 38, intangible assets, 36 foreign payments, etc., etc., etc. Then you got liability standards, so 37 for provisions, contingents. Then you have contract-based standards, right? So this one, where your economic phenomenon involves signing a contract. You can think to these particular accounting standards to help account for a particular transaction. So these standards start with contracts. So contract of sale, a contract which is the lease, a contract which is the financial instrument. It starts there. Then you just got the financial instruments contract, financial instrument standards. As you can see, quite a few of them that we ran through. 32, IFRS 9, 7, IFRS 2, share-based payments is another one for executive compensation. Then you've got group standards. So these are related to consolidated financial statements or group accounts. It gives you the rules for consolidating, for equity accounting, for disclosing stuff in the separate financial statements, for business combinations. So this all relates to accounting for groups of entities, which is very common. And the last broad group is the special standards. So this is just everything else. You've got FX, foreign exchange rather, transactions. You've got government grants, employee benefits, the lovely income taxes, IS 10 again, events after the reporting period, and then prior period errors, changing accounting policies, and changes in estimates. Again, like I said, I don't know what IFRS 22 is. I know SIC 32 is websites. IFRS 17 is that distribution of non-cash. IFRS 1 is provisions for dismantling. IFRS 22 is did you remind me? Okay, effects on prepayments. So where you got a foreign currency prepayment, a question always arises whether or not you have to revalue that prepayment for changes in foreign exchange. Cool. So my advice for this slide, use ChatGPT and create a table that I described so you know everything that you have. And then from there, use the skills that we've learned about identifying an issue in a particular fact pattern. So practice after the session, identifying issues. In fact, what you can do is you can go back to all these corporate scandals. Use Tonguat. Tonguat was actually quite a fascinating one because it had multiple fraud and irregularities. Use Tonguat. Find one of those old articles that tries to explain the fraud that happened at Tonguat, and then using that article, identify all the accounting issues, and then try to scope them into standards. Say, okay, fine, this issue is dealt with that standard, this issue is dealt with that standard, this issue is dealt with that standard. And if you want to take it a step further, then think about how did the fraud happen? So, excuse me. So what was supposed to happen per the standard that you chose versus what actually happened? So how did the fraud happen? And then think about presentation disclosure. Take a lens of an investor. Okay, how did that fraud or misrepresentation change the decisions that were made by the users by changing the way that those accounting phenomenon were presented and disclosed by the reporting entities, right? So compare the two. What Tonguat did versus what they should have done, and then say to yourself, okay, how did the presentation disclosure change? Therefore, as an investor, as a user, as a regulator, how would the decisions I would have made about this company have changed as well? Okay. Okay, so I'm going to skip all these slides because we pretty much spoke about it. So understand how different work, we spoke about that. Spoke about application guidance, we spoke about illustrative examples. I forgot about this one. Cool. What I'll do is I'll just speak to this particular slide to just emphasize the role that judgment plays when it comes to accounting. So we've spoken a lot about the rules, the principles, but we haven't spent time talking about judgments. And I wanted to use this very simple example to illustrate the impact judgment can have on accounting, and the judgment you will have to be applying and justifying in this program. So scenario. So two companies, we've got Alpha, we've got Beta, have entered into identical 25-year lease agreements for specialized equipment. The equipment has a total economic life for 30 years. Both companies must determine whether the lease should be classified as finance or operating under IFRS 16. So both Alpha and Beta are lessors, so they're leasing out this equipment. And if we go back to the accounting standard very quickly, I'm going to skip a lot of steps, but I'll just describe them as we go. Where's IFRS 16? There we go. So first thing I need to have done is, okay, I've got these things that legally are referred to as leases. However, do they reflect the substance of a lease? So the first thing I need to do is identify whether or not my arrangement, so as Beta or Alpha, contains a lease. And if I go to the definition, and I won't go into the details, and if I read it very quickly, you'll see that we'll probably tick all the boxes quite easily. So a lease is the contract. We have a contract, we've entered into an arrangement that conveys the right to control the use of an identified asset. Here, our identified asset is the specialized item for a period of time, 25 years, for consideration. I don't think I have consideration information in there, but assuming I had, I would meet the definition of a lease. Great. So I've got a lease. So let me then go to the scope. So the scope says an entity shall apply this standard to all leases. I have a lease. Okay. Including leases in the sublease, except for, okay, let's just make sure that I don't have any of these exceptions. A lease to explore minerals, oil, natural gas, etc. Nope. I've got a lease for natural gas. Leases of biological assets. Nope. A service concession. Nope. Leases of intellectual property granted by a lessor in the scope of 15. Nope. Rights held under licensing agreements in the scope of 38. Nope. Okay, cool. I'm comfortable that I'm within the scope of IFRS 16. Cool. What's next? Now we need to account for this thing. Okay, boom, boom, boom. I'm going to skip a lot of steps. Okay, I'm a lessor. So I'm going to go to the lessor section in terms of how to account for this lease. A lessor shall classify each of his leases as either operating or financing. Okay, cool. Thank you. And it gives me the rules of how to classify. So a finance lease is a lease where the lessor transfers substantially all risk and rewards to the lessee. And an operating lease is where that does not happen. Okay, that's the principle. Okay, so in my fact pattern here, the equipment has been leased for a total of 25 years, but it has an economic life of 30 years. Okay, does that mean that Alpha and Beta have transferred substantially all risks and rewards of the equipment? That's a great question. We need to apply judgment to answer that question. But typically the accounting standard says, okay, cool. I've given you the overarching principle, but I'm not going to leave you hanging. Okay, let me give you some application guidance to help you, or some guidance to help you apply these criteria. So when performing the assessment above, right, examples of situations that individually or in combination would normally lead to a lease being classified as a finance lease are. So examples means this list is not exhaustive. So we still need to keep in mind the overarching principles. Who is exposed to the risk and rewards of this equipment? Okay, you could say that the lessee is exposed for 25 years, but the lessor is exposed for that extra 5 years when the item comes back, right? So who then is exposed to substantially all? What is substantial, right? What does substantial mean? Do we have a limit? Do we have a threshold? But the standard's like, okay, no worries. We are here to help. Here are some examples to help you conceptualize the principles. So I'm going to ignore all of these examples except for one, where the lease term is for a major part of the economic life of the underlying asset, even if title is not transferred. Okay, thanks. So now I can compare the lease term to the economic life. And if the lease term is a major part of the economic life of the asset, then I can conclude that substantially all risks and rewards have transferred to the lessee because the lessee has this asset for a major part of the life of the asset. But then you're like, okay, but then what is major part mean? And that's not going to be in the accounting standard. Okay. You need to apply your professional judgment. So alpha and beta apply their professional judgment. Alpha believes that if a lease term is at least 80% of the asset's economic life, then they believe that is a major portion. Therefore, in this fact pattern, Alpha Limited would conclude this is a finance lease because we've transferred the risk and rewards to the lessee. Beta, on the other hand, believe that their threshold is 90%. They believe 90% is a major part. Therefore, under their judgment, this lease would not be a finance lease. It would be an operating lease because 25/30 would not meet the 90% threshold. My question to you, who's right? Thoughts? And I hope I've explained that correctly. You can ask me to clarify a few things if you want me to, because I may have rushed through something. I just want to get a sense who is right. Spoiler alert.
Okay, I'll give it a try.
Yes, thank you.
From the scenario, to me, I think the defining moment is around the company procedures, I guess. From Alpha's perspective, their assumptions and policies, they use the 80%, and then from beta perspective, they use the 90%. I would say both of them are correct in terms of how they view the lease, in that they are using their internal policies, I guess, to determine if this is a finance lease or an operating lease. I think that's my perspective to the story, even though I might be inclined to say that the term majority might mean something that is over 50%.
Oh, okay, so you
meaning to say that Alpha in that regard would be correct.
Okay. So so you add an extra element which allow. So you're of the view, using your professional judgment, that major is actually just more than 50%. We don't even need to be as high as these two are going 80 and 90. 50% is fine. Which I'm going to park that point because that's very important. And I see someone in the comment agrees with you. Nigel, do you want to go?
Thank you. I think in our application of now we need to apply standard first. Then if the standard does not answer or give us a straightforward answer, we can bring the professional judgment, because if we start with the professional judgment, we are likely to get lost. For instance, we need to refer to the standard or what the standard says about the duration of the lease. When if it says the majority, we need to apply the standard first before we then talk about our professional judgment. In this case, I think this standard on its own is sufficient enough to say, according to my understanding, the standard on its own is sufficient enough to say a beta is not correct in saying its threshold is 90%. As such, they will not be able to classify it as a finance lease. That's my
Thanks, Nigel. And just to read the Lima's comment very quickly, I agree with Alpha's treatment. However, Alpha is 80%. However, anything above 50% useful life would be deemed as a major part. Okay, cool. So what's happening here is judgment, right? So we've got to turn out, completely agree with Nigel to say we need to learn the accounting standard first, and we only have room to apply judgment where the accounting standard isn't prescriptive, which is often, right? It's far more often than you would realize. And I've also, in getting to this, in whittling down this conversation, I have filtered out so much accounting judgment, right? So we can just focus on this one judgment. What is a major part? So I've got 50% coming from Ledima, and I think Nigel had a similar sort of sentiment. My question then is, and Tom, I think it was as well, had a similar. My question is, how do we firstly justify our judgment? Okay, rather, where's the 50% coming from? Is I guess my question. How can we go about supporting that 50% judgment? Or is it just a number? Is it just based on our feelings that we're coming up with the 50%?
Well, Arson, just to jump in there.
Yeah.
I think IFRS 16 does state all of those requirements have to be met in us deciding whether it's a finance lease or not. And so just considering other aspects as well, in addition to this one about the major part of the economic life, would be a guiding source as well to my professional judgment. So to say that I'm leaning towards 50%, considering that I'm meeting some of the criterias as well, we're building up to my conclusion as to whether it's a finance lease or not.
Right.
So that's where my 50% is coming from.
Right. And that's a good point. So you understand the objective of what the standard is trying to do. We're trying to assess, okay, have we transferred risks and rewards here to the lessee? And you're saying, okay, I may be a little bit gray on one requirement, but then I'm gray on the other one as well. And maybe I'm a little bit darker gray on the other one as well. So if I stand back and look at this holistically, I'm applying my professional judgment to say that we meet the criteria of a finance lease, and I'm going to count for it as such. I'm hoping I've summarized what you're saying, because I see you've come on mute. So I'm hoping I haven't butchered completely what you said.
No, that's exactly like where I'm coming from with.
Perfect. So that is professional judgment. So we've gone beyond what the standard says, because someone's thinking with an AIC, ACA, or brain, or just purely rules-based would say, I don't meet this criteria, I don't meet either one of them, therefore I'm an operating lease forward. No, that is not how we think as when we try to apply IFRS, when we're trying to apply the the principles-based IFRS. Here, we understand the overarching principles. We're given examples of how it all works. Therefore, and it even says here, individually or in combination. And then what Limo was describing was, in combination, I'm coming to the same conclusion. Okay, so that's just another illustration of how professional judgment works. How else can you use professional judgment? You can benchmark, right? So you can see what's generally accepted to be the thresholds for a particular requirement. You can look to other accounting frameworks. Sometimes people do that. So, example, in US GAAP, they have a hard deadline. They have a hard threshold. I can't remember whether it's 80 or 90%, but it's one of the two. You can refer to that in justifying your judgment. So you can look to peers, you can look to industry practice, you can look to different accounting frameworks. You can almost like judgment should never be just about pure feeling. It should always be about trying to justify your a view, or to come to like a rational view. And at an APC world, because you have the power of the internet over the 5 days, you can do all of this stuff, right? You can research these things, and you can get some answers. So long story short, neither of these sort of entities are wrong. It all comes down to sort of how they apply and justify their professional judgment. But as you can see, the outcome is extremely different depending on their judgment, right? So one uses judgment to say our policy is 80%. Other one uses judgment to say our policy is 90%. But now we're getting two completely different outcomes in terms of lease accounting. So what's the next piece that now becomes extremely important is then the disclosure. So I remember when we initially started the session, I said one of the key disclosures for any accounting statements in IS1 is your critical accounting estimates and judgments. Alpha and beta would need to disclose this, assuming it makes a big impact to the financial statements, as a critical judgment, i.e. this is how we look at it. So if you're a user and you pick up the two sets of financial statements and you know they enter into identical leases, but they're treating them very differently, then you know exactly why, because of the disclosure. But you would hope that because of what I just described in terms of how best to apply professional judgment, which involves peer comparisons, and also industry engagement, and just doing some research, you would hope that alpha and beta still generally kind of converge to the same conclusion. But invariably, it doesn't necessarily always happen. Cool. So in the last 5 minutes, I know I promised, I overpromised and I'm under delivering, but at least I'm still within my time. Let's cast our minds into the future. So another thing that's very important for you to realize at this stage of the game is that accounting is an ever evolving beast. So the IFRS 16 that we've been speaking about all day or morning, that is a new standard. That is it's fresh off the press. I think it's about 3 years old now, if not 2, but I think it's 3. IFRS 15 is also new, off the press now for I think 4 years. I think it was 15 first, then no, it was the other way around. No, can't remember. IFRS 9 is also relatively new. We've got 17 that was just brand new, 1 year old. We've got IFRS 18 now. You're replacing IAS 1, brand new standard. So IFRS is ever evolving, and it's doing so in response to what's happening in the world. So again, it is extremely important that we remain holistic corporate professionals, like I mentioned earlier on. So I was very happy that we were all able to share a lot of insights, some of which I was even like, oh yeah, I mean, I didn't realize that much happened with Tonguat, in terms of what happened with these copper scandals. So I'm very pleased that we are sort of enveloping ourselves in this world, because this is the world, this is the profession that you are entering. And as you just read about everything that's happening, business news, corporate news, you just understand the lingo, you understand what's going on, and that's what's driving corporate reporting. Because remember, the objective is to assist stakeholders in making relevant decisions. Stakeholders need to make decisions that are relevant in the world that we live in today. Key example, climate change. Right? Climate change has been a top topic for a couple of years now. And it's just the conversation on climate change is just accelerating at a faster and faster pace. And in doing so, a lot of companies have been making climate commitments and disclosing things that they're trying to do. And there's been this perceived mismatch between these commitments, and some companies are not meeting their commitments, as you're seeing on the right here on my slides, and the lack of any provisions or expenses being put into the financial statements to reflect those commitments or failures to meet those commitments. So because of that, and many other reasons, so not just that, you see very recently that on 12th November, like about 2 months ago, the ISB is making amendments or proposing amendments to IAS 37 to tackle these perceived deficiencies. The new standard will probably be published in 2025 or this year. And then, of course, on the other side, as we all aware, like I was literally speaking about ChatGPT earlier, the amount of spend going into AI and software is immense. Obviously, NVIDIA has been a massive beneficiary of all of that, a lot of that spend, and hence that share price. And anyone bought that share a couple of years ago, you must be very happy with yourself. But the users of financial statements have been complaining that they're not getting the information that they need from the financial statements to assess this IT spend and the value that it has or does not have. Right, you can pick up a set of financial statements now of a company that has a massive IT spend or spend on intangible assets, and there could be literally no asset on the balance sheet, or maybe not a meaningful one. And the question has been asked as to like whether or not the intangible asset standard, so IAS 38, is fit for purpose. Another example would be cryptocurrency and stablecoins. Now, as you can see, the new president of America seems to be quite pro these cryptocurrencies / stablecoins. But although the principles in there, in theory, help are there to allow you to account for these types of accounting phenomenon, i.e., purchasing crypto or stablecoins, the outcome does not make any sense because you don't meet the definition of cash, nor a cash equivalent, and then you're almost forced into the intangible asset standard. But then the intangible asset standard, either you have a revaluation model through other comprehensive income, which doesn't make sense for an instrument that has such volatile movement in price. But I guess maybe it does make sense if you want to avoid the volatility. But then at the same time, it requires you to depreciate the coin. I mean, then again, you could say, okay, fine, it's an indefinite useful life, and therefore I'm going to do an impairment test every reporting period. But that's such a clunky a process. Shouldn't you just be at fair value through profit and loss? So all of those type of questions have arose because the principles that are there, the outcome is not intuitive to what economically is the reality of these coins, or it's fast becoming the reality of these coins. So again, because of that, we've got a massive review of IAS 38 that's underway. The turnaround time of this will probably be a little bit longer, maybe 2026, 2027, but we'll see what will happen. But now you've got two standards that I described as old, 37 and 38, getting revamps. We'll see how the 38 one goes, but we have an idea in terms of how the 37 one, provisions one, is going. So another key skill that you're going to have to be comfortable with is keeping abreast to all of these developments, and then also getting used to, if you've become accustomed to IAS 37 in one way because you've dealt with the standard before, you may be tasked with having to deal with IAS 37 under the new way. So being able to unlearn the old, learn the new, and also to understand the differences and the why of the change becomes extremely important when it comes to dealing with as accounting standards change. Cool. In closing, there's just a slide here that I'm not going to run through that relates to just the foundational standards, that if you have a gap, if you want to dive deeper into some of these standards, you're more than welcome to. But I think the ChatGPT option is probably the best. What you could do as another ChatGPT option is just ask it to share with you a quick transcript of a quick Q&A or a lesson on IAS 16. And it will give you a nice little summary or lesson of the standard. And I think that would be extremely sufficient just to give you an idea or a flavor of what's sitting in the standard and contextualizing some of the concepts we've been speaking to. But also you've got access to CTA on demand resources. And ultimately what's sitting in here is detailed slides of these accounting standards, but also videos as well in terms of that you can into some of the lectures that were recorded in the past, but also some question banks that include some questions that you can work with, and of course you can expect some tutorials as well into the future. So we're going to leave it here in terms of our session. Again, to reiterate, you're not going to learn that entire book in the next 3 months. Focus on process and think about some of the homeworks that I've shared with you today, and just reflect on it and etc. Priority topics will be marked on the timetable, so you can expect that. Then I've just shared with you the self-study topics. Integrated thinking will be quite an important principle. So now obviously we talk about accounting only, but integrated thinking will become a bigger theme throughout this whole process. And importantly, reflect, right? Repetition is the father of learning. So make sure you get in another repetition. Take a break, have some lunch, then come back, just go through the slide deck, reflect, and then which will be uploaded, and then and yeah, make sure you absorb it all. Okay. Right, so I was standing in for Rendani today. Not sure whether I'll be seeing you anytime soon or whether Rendani will continue taking the sessions from here. If I do see you, yeah, we're really looking forward to seeing you soon. If not, then I'll definitely see you in the main APC course, where I'll definitely be taking all the classes. Okay, I had a fantastic time. I hope you all did too. Thank you. If any questions, I'm here for another 5 minutes if you have any burning questions. Otherwise, this is the end of the session. And thank you so much, everyone. Okay, I take it no questions. All right, phenomenal. Thanks so much, everyone. Have a fantastic afternoon further, and I'll see you soon. And remember, reflect. Cheers. Thanks, everyone.